Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, March 6, 2019. I wanted to do a quick update on the markets, and time permitting, I'll roll into some of the recent trade ideas and the charts that I've been watching, posting in the morning recently. So, in other words, some of those are unofficial trade ideas, or at least trade setups. But again, time permitting. First and foremost, I want to talk about the market. Some of my thoughts or things I think are worth sharing at this point in time. Um, I guess the bigger picture, and this formulates into some of the trade ideas on the site, my views on the market, which may or may not be yours. As I said, I always do my best to identify key levels, support levels, resistance levels, levels that could provide a pullback. So if you're of the mindset you're looking to buy a dip, you're long or you want to be long, again, the same targets that I might lay out on short trades, pullback trades, would be the same levels I expect a reaction, and those are objective levels to go long. But really, what I wanted to talk on is the bigger picture as far as trading strategy. And on that, real quick, there's a way I look at trading and investing, because the two are closely related. I do separate them. I am a long-term investor with 401ks, IRAs, those type of long-term retirement accounts, kids' college funds, stuff like that, and then also an active trader. And so the bigger picture, if you recall, last summer, somewhere along this point here, I mentioned just getting out, taking money out of my 401ks, long-term funds, and going into cash at that point, and then being short, and then in treasury bonds on the not short, long-term funds. I'm talking things that you can't actively trade, nor should you be actively trading. 401k type plans, qualified plans through an employer. Those are typically mutual funds within there, so you can't actively trade if you want to, because most 401k providers will hit you with active trading fees, penalties if you trade in and out too much. And again, it's not a good idea to try to actively trade your 401k or those type of funds. The other thing too is they're usually almost always mutual funds for most part, and mutual funds, you can't time entries and exits like you can on swing trading. So like, let's say you're right here, you were long, then you decided, okay, we have a little pullback here. But then when the bottom starts falling out, you try to get out. Well, the thing about a mutual fund, whether you put your order in at 8 o'clock that morning because you see the futures moving lower and breaking a key support level, it doesn't matter. Put it in at 8 in the morning, your broker will not fill that order. You get that day's closing price. So the market can plunge. It's done it before, and it'll do it again. It can drop 5% in a day, 5% or more, and you're going to get the closing price. Same thing if you waited for some green light to come on. I mentioned scaling back in on my 401k money all the way here from this point, about right here, down to right here, all the way down to the 24th, and then continued on. But the point is, if you tried to sit in cash up to that point, this is where you bought. Even if that morning you saw the futures moving up, you saw some short-term levels get taken out, it does not matter. When you go and click your mouse on Schwab, Fidelity, whatever, the morning of the 27th, and you say, buy it into the U.S. equity funds, whatever it is, this is the price you get, not that price. You swing trade, you buy an ETF or you trade futures, you got it in the morning, and you made what was that gain that day? Let's not get too off track. It was a huge gain in one day. I think it was over 5%, especially in QQQ. So that's the point I'm trying to make. And bigger picture, I guess to drive it home, is I look at things from a longer term investing perspective as strategic trades. And so when I scaled out, took money out of long-term funds back there, went to cash, that was a strategic trade because I had a high degree of confidence we were going to get a significant drop into the year end, and then at that point I started scaling in long into treasuries right here, and then stocks here and all here, and then got out. So these right here were strategic trades, or tactical, I'm sorry. The strategy is this, and this is where I'm trying to go with this, guys. Sorry if I'm all over the place. Right now, I'm still working off, based on my analysis, and my convictions aren't rock solid, but they're good enough to have that strategy. I'm still working off the expectation that this is a bear market rally with a much larger drop to come. So this is my strategic plan here. And again, so I've already scaled out I have a very small cash position. I'm waiting to see some solid evidence. I'm sorry, equity position, but very small token amount. Scaled out mostly from here to here in equities and 401k type funds, things that I don't actively trade, and into some treasuries, and mostly cash. And we'll be at that point. Now, like any plan, if the market tells me to, my strategy will gradually shift and change. Doesn't mean if we go to new highs that I'm all of a sudden 100% in equity as long. Don't get me wrong. If the risk reward isn't attractive, if the technicals don't tell me so, I'll stay in cash, treasuries, whatever alternative assets I need to be at that point in time. And so that is the long-term strategy. Now, where it comes into swing trading, and also you can tactically trade to an extent in those longer-term accounts, and that's what I was saying I did there. That's what I was talking about with the 401ks. But with that, working off my current preferred scenario, which is this, that tells me, number one, at this point in time, like I said, I'm mostly cash in the long-term IRA type accounts, and obviously, short in the swing trading accounts. But what really matters is if you have an opinion. If you don't have an opinion, keep things light, stay out of the market, don't force it. But if you're of the mindset that this is a decent chance, and it doesn't have to be better than 50-50. In fact, I won't give it better than 50-50 odds. Let's just say that there is only a 30 or 33% chance that this is a bear market rally and we're going to drop another 20-30+% from here. Let's just say that. So then that means, well, okay, and with the alternative, of course, being the market goes on and breaks out, makes a new high in 2019, and keeps puts this bull market into the longest in history in the record books. That'll happen, was it July? I guess March 9th. Needs to take out, not today. It'll be March 9th. So let's just say that has a, better than a, 2/3 chance. However, what do you think the upside? If you think the upside from this point is 30%, let's say 25 to 30% before the next major trend down, like I do if we turn to the downside, then great, go long. I don't see it. Anything is possible, and if I have to miss out on most of that, my long-term funds, so be it. I've already locked in gains for the year that I think I'll outperform the S&P by year end, just from what I gained, in the 401ks coming up to this point in long-term funds. Now, so where I'm going with this, it's just like gambling. I use the analysis or the analogy of going to the horse track. Bet on the sure thing, the winner, and those odds are going to drop down. They can get down, all the way down to 1-to-1 odds. So bet $100, you're going to walk away with $100, or you lose everything. Now, you bet on the long shot, and you might have 30-to-1 odds. So that's sort of, you can look at it this way. You have a much lower chance or not in this case, not much lower. It's not 30-to-1. Let's just say it's 1-to-3 or something of that scenario playing out. But the reward is tremendous. And so that would be, I use a baseball analogy too, that would be hitting a home run or a grand slam to be short, scaling in short right now, even on your swing trade accounts. In other words, at this point in time, as I've said on those trades with relatively shallow targets, I'm viewing the shorts right now, as I was back here, as tactical short trades, meaning short-term, single-digit gains on most of the index funds, maybe double-digit on TVIX only because it's leveraged, things like that. So that's what I'm working off of right now. However, I am open to the possibility, and that's the whole point that I've been talking on for a few minutes here, is that I am open to this possibility, to allowing for that. And even if it means, whereas I would normally, if my view was this, if I thought the market, if I thought my preferred scenario was a market going to new highs soon and getting a pullback here, which again is very possible, then I would be covering at my preferred targets. And again, those would be the final targets on the trades right now. I would be covering to minimize any givebacks because I would expect a reversal there. And very often, quite often, you'd be surprised if you go back over the years how many of the final targets on the trades, official trade ideas, are hit almost to the penny in reverse, and then go on to, completely change trend from there. Not always, but it happens a lot. And at this point in time, I am more apt, or may, or possibly will be. I want to see how things go. Let's not get ahead of ourselves, guys. I want you to know I'm not, over the years, I've learned to not get excited about anything, but I'm liking what I'm seeing here. I like some short setups here. I liked them here. They didn't pan out, but I like them much better here. So going back into that QQQ trade for what? I think the third time we had it, long. We were long on it there. We were short over here. So I think this is number 3. We had 2 stopped out for relatively small losses. And this is not a stubborn thing, a bullheaded thing. The way I am in trading, I am indifferent to a stock. I will stay on a stock. I'm also tenacious. If I continue to see developments in a chart, maybe I'm in early, but if the charts are still looking for a, setting up for a nice reversal, and that's what I do a lot. I catch tops and bottoms. I know most people don't do that. Most people say it can't be done, and you certainly get some cuts trying to catch falling knives and shooting, rockets that are heading up. But what happens is keep those losses small. I think, what were we, probably 3% losses on the QQQ on average on the index trades. Keep those small, and then get a double-digit runner here, 10, 20, maybe even 30% gain. So that's the mindset I'm working off of now, and where I was going. If, again, let's try to fast forward a week or two, and if we see what I suspect we see, some very impulsive selling, some early support levels where the dip buyers would expect things to bounce, get taken out with either a minimal or no reaction, then it could tell us that something else is going on here. And at that point, instead of, let's just say, covering right here on SPY, I'm not short SPY, but let's just say I was, and that's my target. I may just at that point, as it approaches that level, instead of covering and reversing to go long as I would if I thought the market was going to new highs, I may just trail stops down, leave a relatively wide stop, allow for reaction there, and then be open up for the possibility of what I call a runner trade, a trade that breaks that level. Because if this is a bear market rally, let's just say that. If this is a bear market rally, and I'll tell you without waffling what I think will happen, and there are no guarantees, what I think will happen, and I've covered this before, there's a zone right here, and that's the top of the zone, those reaction lows there. And let's say this is the bottom of the zone. That is what we'll call it the WTF zone. That is the zone where if any correction that we have, whether it's this one now or one that comes later in the year, if the market gets in there in that zone, it will be, the bulls, the dip buyers, those that are bullish, citing how the recession's not in sight in 2019, maybe down the road 2020. That's where they will start to say, wait a minute, what's going on here? This was a key support level. I've been buying the dip on the way down, buying pullbacks. It was working, it was great here, it was working great, but all of a sudden it's not working. This is that point of recognition, or WTF moment, I believe, in this zone somewhere where you will not continue to see a orderly or semi-orderly pullback. Remember, one thing about corrections is why I love shorting stocks. They tend to fall faster than they rise. I'll say this right now. I wouldn't be surprised, and I almost expect to see on a correction soon, to see at least the last, I already talked about, the last 2 weeks of gains wiped out in just a couple days, and we might already have that soon. But so anyway, stocks fall faster than they rise, but you'll probably work your way down there. But if and as you get down to this level, I think this is where you start to see waterfall type selling, where they realize, those that were looking for new highs, that hey, something else is going on here. And of course the headlines will change, sentiment will change, and you'll hear every other reason why it was a good reason to sell here, which they're telling you now why you want to buy. So anyways, just keep that in mind. And again, so there's that mindset where if I'm if I see what I want to see in the coming days or weeks here, then I may extend the targets on the short trades and open up and allow for runner trades. And again, if you want to cover, I list targets or levels that I think will get a reaction, and I'll try to update those trades as often as possible. All right, one other thing, and then we'll move off this chart. We'll look at a few more. Okay, remember, if that scenario is going to happen, and again, we'll see. Here's what happens at tops. You don't go up from one of the strongest rallies in decades to going down. V bottoms are much more common than V tops. Tops usually roll. Look at this top right here. That was one of the most powerful. It came at the end of one of the strongest bull rallies in years, if not decades. That really was a tail end of the Trump pump from a couple of years ago. But look how the top came. Here's what happens. Okay, so you get a top and a little topping action. All of a sudden, the momentum's broken. And you get a down day, a couple down days. No big deal, right? We had a couple along the way, some consolidations. But all of a sudden, you reach that point. And it usually takes a few days, and then everybody, when you have a lopsided, one-sided trade where everybody's long, everybody's bullish, shorts have just been blown out time and time again, so now short interest is low, that's where you get this. So keep in mind, and here's a topping process here, and then you start to have some candles, orderly selling, and then all of a sudden, boom. I am open to that scenario right now. Just keep that in mind. So if you see it, you may want to extend your stops. I know there's a lot just wanting to get some of the money back that they've lost shorting and maybe want to cover the first dips, and hey, that's fine. I'll never tell anyone not to book a profit where you're comfortable. I'm just trying to, maybe open your eyes to the potential that if, again, a big if, this is a bear market rally, then instead of seeing what I drew out before, this little correction, little pullback, you may see, some accelerating selling, and then, potential for a whole lot more. And of course, if that starts to materialize, we're not going to go down 30% in a day or two. So don't worry about that. There'll be plenty of time to work our way down to that WTF zone. And if we even start to approach it, I will then begin to kind of zoom back out to those longer term charts and look at the possibilities and the potentials, look at some levels to watch, and then focus on longer term targets. And if as we're coming up to some levels here that look like great levels to cover those shorts or to maybe even go long, believe me, I've been starving for some long trades that I was comfortable with for quite a while now, and I don't want to force them out. So I may be adding some more longs. Right now, as you probably notice, I'm kind of looking into commodities arena. I'm watching gold, watching bonds. I'm watching non-equity things. This isn't my type of market, and I don't care if it goes up 30% from here without a pullback and I miss it. I don't chase or go into trades that I'm not comfortable with. So, most equities will fall when you have this water type fall sell-off, even if they're usually not highly correlated with the market. When you have waterfall type selling, almost everything goes down across the board. If it's in a sector or an index that's even remotely related to the market, it usually goes down. Even the defensive stocks, REITs and utilities, they get dragged down during those type of sell-offs. So there's very few places to hide other than assets that are inversely correlated or flight to safety assets like government bonds, gold, things like that. All right, well, I'm going to keep it on the markets. I'll probably do a separate video or other updates for members on those other things we're watching, the commodities, gold, oil, any other individual trade ideas. Keep this one just on the broad markets now. So you can see we're already starting to get that acceleration in selling. It all started with, a lopsided, one-sided trend. And it's about momentum. This is a momentum trade. When the momentum broke right here, to some, I tried to, not over harp on it, but it was a start. 3 down days, 3 red candles. These candles show the daily closes on SPY. And as I said, we had not had 3 red closes since this entire thing started back on December 27th. So that was, a start. Okay, so we had a little pop-up the other day, and that did, I'm sure, one of two things. Generally speaking, took just a knife through the heart of a lot, those, bears or those shorts, saying, oh, wow, we had a couple little streak going here, we popped up. and then we even tried to pop that level there. But what happened, to me, that's even more bearish. It's better to see a second failed, really 3 failed attempts if you look at that candle as well, than just one. More failures, and then we popped above it intraday and reversed in a big red candle. And now, like I said, that was a bearish engulfing candle, meaning the body of this candle right here engulfed the previous day's candle, that nice little doji right there. And what I said I wanted to see after bearish engulfing, because it's not enough by itself, follow through to the downside. And so far, that's what we have, 2 more red candles. And I also said that we've been trading sideways for a couple weeks. And so again, this is why I love shorting. Stocks tend to fall faster than they rise. As strong as this rally was up to the top, here, you can look at it this way. If you're visual person, there's a drop there, and that's how long it took us. That's not a symmetrical V right there, is it? No, because stocks tend to fall much faster than they rise. So it would not surprise me in the least to see now, what do we have? There's a couple months of gains wiped out in just a few days here if this thing gets going. Again, I'm seeing a disconnect in the the macroeconomic data that the market is ignoring. So I think there's a fundamental case as well as a technical case that we could get a pretty sharp drop. And so we'll go from there, see what happens. I'm just trying to point out that, hey, don't you may not want to take the quick buck and miss out if there is going to be a quick swoon down. Quick look at QQQ. As I was repeatedly saying for weeks right here, looking for the correction, calling for it, but was adamant with one phrase: when tech breaks, the market breaks. So we were watching more so than QQQ. I was watching XLK day in, day out. That's where the updates were here. That's saying there's the breakdown came there. And QQQ is mostly, it's 70% or 60% tech stocks. And I said when tech breaks, the market breaks. It's also the largest component of the S&P 500, largest sector. And same thing right now. Tech's been holding up recently, but we're also, you look at it good or bad. That is deterioration. The S&P 500 has a lot more stocks, a lot more sectors, it's a lot more diversified. The S&P is rolling over, the broad market's rolling over most stocks. Lately, as I pointed out last few days, Amazon and Facebook. You've had a couple stocks holding tech up. And so, hey, maybe a good thing. You can look at it glass half empty or half full. I know some people have made that case that, okay, a few stocks, the market leaders, they'll bring the market up. Maybe so, but I look at that the other way. I see most stocks crumbling. So point right now, we still need to undercut this recent range right here. So look for tech to break. I think if you see a big red candle through that level, that should open the door for, I think, at least a move. I may put this video out there for a public video for YouTube subscribers as well. So far, it's just general market analysis and talking points. We do have some short trades, so I'm not going to go over those levels. But you can see generic levels right here. And this really is what I'm looking at. Minimum for this pullback here is coming down to about this level here on QQQ. We'll call it roughly, what is that, 166.50, give or take. Yes, that would undercut the 50 and the 200-day, and I'm not overly concerned about the bearish cross on these at all. You get whipsaw signals all the time. You can say I'm dismissing that. We'll see. Let's see if the algos step in and buy it. But so far, we have that crossover on the 50 and 200 and nothing. Also, a lot of people watch the 50 SMA and 200 SMAs. These are the EMAs. But again, I put price action first and foremost. So let's get down to that. So far, like I said, a little more work to be done. When I look at this daily chart, we fired off some decent at least sell signals or bearish developments, like the crossover on the PPO, the RSI rolling over from oversold levels, the market failing at resistance, all those checks. But we really need price is first and foremost. So that's it. Let's see it. Let's see us undercut those lows. What was that level? February 21st I keep talking about. On the 21st, I want to see that low get taken out. I've talked about that several times. That's all the way right here. But at this point in time, I'm even tell you right now, more so than that low. Let's just see us get below about 172 or so. That should do the trick. All right, finally. Yeah, let's just wrap it up with IWM. You usually get more bang for your buck trading the small caps than the large caps because they're higher growth companies. So when things are good, they grow faster rate than large caps, and when things are bad, they tend to fall more. So this is the point that I drive home repeatedly, and why I don't chase extended rallies, and why how stocks tend to fall much faster than they rise. Let's just look at where we're at today on IWM. We have now wiped out at where we're at now, goes all the way back, and if you see the pop-up box to the left, that's 20 and a half days. So at the end of the day today, if we just close where we are now, we've wiped out 3 weeks, the previous 3 weeks of gains so far. And technically the top was right here, but most of that came in just the last 3 days. So you can see these red candles are bigger than those, and again, don't underestimate things, whether you are bullish or bearish. Don't underestimate if the momentum starts to go, and all of a sudden that boat, everybody's been on one side of the boat. They were all on one side here. We know what side that was, and then they've all been on the other side here. That's just the nature of this market, really, in the last 2 years. We came off a period of unprecedented volatility since the Trump pump, since Trump was elected. Never in the history of the financial markets seen volatility at such low levels and for so long. It's unprecedented. You can look at the VIX. It was written, well documented. But what happened is I'm seeing a market that is increasingly getting more volatile and lopsided. You got these algo trading programs. They go crazy. They jump on whatever side of the trade. They're fast. They're computers. They don't have emotions. When everyone's piling on one side of the trade, they jump in front of it and they exacerbate the selling. You also have the everything else that caused this that I talked about back here. That why this would happen. The institutions, the pension funds, hedge funds, everybody was too heavy, overweighted in equities, underweighted in risk-off assets. So you saw that rebalancing, and then you saw things get to snap down or shoot down to the extreme on the other side when you just had that capitulation type selling, and then the reinflation trade, and a lot of that was also driven by stock buybacks. I have very little doubt on that. All right, and we'll just end it here. I mean, I have a bunch of different boards on IWM. I can show you a lot of different boards. Those are previous targets from I don't know when. Came off a different board here, but the one I'm watching right now is this. We had this steep wedge right here off the lows. Boom, right there. Big, sharp, rising wedge. Breakdown so far. And these are all potential stopping points. They're not fine-tuned, but and that would also be, I went over SPY earlier, my WTF zone, if you call it. That would most certainly be, and I'm going to show you all the way back here. I'm going to drag that line because this level here, that upper level, is very significant support. It was not just support because you had a lot of reactions here. That's a big part of it. The fact that when we broke it here, you had initial impulsive selling, a back test, and a rejection, and then the bottom fell out. That validates that as a very important level. On the way up, we consolidate. We hit it, consolidated around there a little bit, and then we powered on through it. So I can just say this. If you are longer term bullish on the markets and we get to that level, I can't think of a more objective, better buying point. Not that I will. Maybe I will be stepping in there. Maybe I'll be stepping in with both fists when we get there, if the technicals confirm and the way things happen. Again, if we get there, that's as much as IWM's already dropped in the last few days, that's still another 6% lower. So call it around 145. But if you smash through that level like it's not even there, I expect at least a reaction on the initial tag, but we'll see. Maybe not. Sometimes that doesn't happen. If you do break that level, with every tick lower, I think the odds go up exponentially for a waterfall type sell-off. So, I'll leave it at this. Things can happen a lot faster than you think, so just be prepared, and same with the reversals. So I'm talking about what can happen on the downside, but that goes the same on the upside. If one of these levels will be the one that contains the next pullback, including this pullback, we're already at my first target right now. Expect the buyers can step in fiercely. Maybe that coincides with news on the trade deals, maybe not. So This is where trading gets tough, guys. You pick your levels, but remember, like I said, it's like buying that ticket. When you bet on the horses, unlike that ticket that you can't change your mind before the race starts or afterwards, in trading you can. And so if you buy any one of these levels, you're buying the dip and you break it, you can have a stop just below it. Or maybe another way to do it, taking a longer term approach, I just showed you these 4 arrows, that's your scale-in zone for a long. Scaling down to there for the next leg up, quantify it, make sure that the risk, the amount that you're going to lose if you stop out under that level. Because if that's your plan, and I'm just telling you one potential plan to scale in from here, your stop should be somewhat below. I can tell you if they run it that low, they'll probably want to undercut it to blow out any stops. So you don't want to have a stop at 144.93, maybe a little below, and but you get stopped out, nothing ventured, nothing gained. Again, if that's your mindset. However, and if you think this market, this was a bear market rally that may have ended, then what you want to do is, in reverse, you just trail your stops down. If you start to get to that 145-ish level, maybe lower stops along the way, keep it pretty wide. Bear markets, or it doesn't matter, bull or bear market, volatility is high. You can't argue that. You run a 1-2% stop on IWM, you might as well go home if you're swing trading. Day trading is one thing. Swing trading, don't bother. You're going to get stopped out. So just keep your position size small enough that you can allow yourself a 5-6% loss on that trade, maybe even greater if you're going for that grand slam, and then trail your stops down, and you'll know it when you see it. If we break that level and you start to see that waterfall sell-off, I would not try to step in and buy that previous low. That's just me. Maybe something will change at that time in the charts that I see, but I think we'll probably with some monopoly, pass go, don't collect, don't pass go or collect $200, however that saying went. That I think will happen if and when we get into that WTF zone. We're going to end it here. Long video, maybe for nothing. Who knows? Let's see. This dip may get bought up, and I just wasted 30 minutes of my life talking about it. But as of now, like I said, I want to get out in front of these things because the markets move fast. If we get into some type of meltdown type sell-off soon, it takes me a while to do these videos, upload them, get them out there, and if it's public content, that will be usually end of day stuff anyway. So we'll wrap it up here. It's been Randy Finney with Right Side of the Chart, and best of luck on your trades.